Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at POET technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices, and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10 a day with VIP indicators. VIP Indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10 is not guaranteed. Use these tools for education and analysis only. Manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
So today we are really trying to unpack something pretty fascinating. We want to figure out if POET is, genuinely the critical missing link in global AI infrastructure, or if it's just this massive speculative cash sink.
Yeah, exactly. It's a huge question right now.
Because, whenever you hear about the AI boom, your mind probably goes straight to the brains of the operation, right? Like the GPUs.
Oh, absolutely. Everyone is completely obsessed with raw computing power.
Right. But here's the reality, and it's something you really have to consider. You can have the biggest, fastest brain in the world, and it is completely useless if it doesn't have a nervous system to transmit those signals to the rest of the body.
Yeah, the data transfer is the real bottleneck now.
Exactly. And that is exactly where POET is attempting to plant its flag. They want to be the architect of the optical nervous system for the entire AI industry.
Which is such a fascinating angle because of the physical limitations the industry is slamming into right now. Hyperscalers. Those massive warehouse-sized data centers running the AI models you use every day, they have all the GPU brains they could ever want.
Right. They're stacked to the ceiling.
Exactly. But they're hitting a literal physical wall when it comes to data transfer speeds and heat. Because if you push mass amounts of data back and forth using traditional electrical connections, meaning like electrons moving through copper wires, you create friction.
And friction means heat. A lot of it.
So much heat. To move more data, you have to push more power, which creates so much heat that you actually risk melting the server racks. It's what the industry calls the 1,000-watt thermal wall.
The 1,000-watt thermal wall, man, that sounds intense. But that is exactly why the shift to optics is so critical, right?
Yeah, it changes the whole game.
Because instead of electrons pushing through copper, you are sending photons, like actual particles of light, through glass. It is exponentially faster, and crucially, it doesn't generate that friction. It stays cool.
Right, which solves the melting server rack problem.
Exactly. But that sets up this incredible tension we're seeing with POET today, because for years, this company has operated in a highly technical, relatively quiet R&D phase. They were just, tinkering in the lab with this light-based technology.
Very under the radar.
Yeah, completely under the radar. But now, they are stepping out of the lab and straight into the chaotic, high-stakes commercial spotlight. We are looking at a story of massive, world-changing technological potential going head-to-head with immediate, gritty financial reality.
It really is the classic friction point, isn't it? Like between what a groundbreaking technology can be in the future and what the actual balance sheet looks like today.
Right, because we are talking about laying the physical highways for AI.
Right.
And laying infrastructure requires immense patience and capital. All right, let's move into the wealth building context.
Because if you are going to look at a company making this kind of massive transition, you really have to understand its place in a long-term portfolio.
Yeah, this is absolutely not a quick swing trade. You can't just jump in and out. This is a foundational play on a multi-year AI infrastructure capital expenditure supercycle.
Yeah, and if we connect this to the bigger picture for you, the structural bottleneck in AI is no longer just, how many calculations a chip can do per second. The real bottleneck is efficiency.
Right. How fast can you move it without burning the place down?
Exactly. So investing in POET is essentially placing a bet on those structural highways between the chips. And you're doing it well before the massive 2027 hyperscaler deployment cycle really kicks into high gear.
Okay, here is an analogy that makes this really clear for me. Think back to the early days of the internet, like the late 90s and early 2000s.
Oh, the Wild West.
Yeah. Back then, everyone wanted to buy the flashy .com websites. But the smart, patient money was looking at the fiber optic cable manufacturers, the companies that were physically laying the glass in the ground that the internet would eventually run on.
That's a really good comparison.
Right. Investing in POET is a lot like investing in those early fiber manufacturers. It is a true picks and shovels play. But let's be honest, playing the picks and shovels angle requires a lot of patience.
So much patience.
And it requires a remarkably high risk tolerance because you are just so early to the party.
It absolutely does require patience, but that is exactly where the asymmetric upside comes from. For patient capital that is willing to hold for an 18 to 24-month target horizon, the potential reward heavily outweighs the current turbulence.
If they can survive the turbulence, that is.
Well, yeah, but you're buying into the infrastructure layer right as the entire industry realizes they desperately need it to scale.
That makes sense. But the gap between their grand vision and their current bank account is where the real tension lies for me. Now let's look at the fundamentals.
Because we do have to balance that massive upcoming S-curve of adoption with the stark reality of a pre-revenue company.
Yeah, and I use the term pre-revenue deliberately because if you look at the numbers right now, they require some serious conviction from anyone holding the stock.
Okay, let's lay the numbers out to see the full picture.
PO8 reported an annual revenue of just over $1.1 million.
Which is tiny.
It's essentially nothing in the semiconductor world.
Okay.
And against that $1.1 million, they had a massive $63 million net loss.
Ouch.
Right. And if we look at the recent Q1 2026 numbers, it's a net loss of $12.3 million for the quarter, which comes out to about $0.08 per share. They are burning through cash at a blistering pace as they try to transition from R&D to actual product development.
It's a lot of cash going out the door.
Seeing $1.1 million in revenue against a $12.3 million quarterly loss is just incredibly tough to swallow. It's the kind of cash bleed that absolutely terrifies traditional value investors.
It is a steep cash bleed, undeniably. Building physical technology costs real money. But this raises an important question you have to ask yourself.
Okay, what's that?
How many pre-revenue startups actually possess a mass production mode built in from day one? Because the bullish thesis here entirely hinges on a massive upcoming revenue S-curve.
Okay, I hear you on the moat thing, but moats don't pay the electric bill, you know? I'm looking at these pre-revenue numbers, and I'm struggling to see where the actual cash is going to come from to survive until 2027. Walk us through that S-curve. Where's the actual revenue visibility coming from?
It's coming from concrete deals. First, you have a firm production order valued at over $5 million for their POET Infinity optical engines. And those shipments are expected in the second half of 2026.
Okay, so that gives you near-term validation.
Exactly. But the real game changer is the landmark supply agreement with Lumilence. That deal features a $50 million initial purchase order.
Wait, $50 million just to start?
Just to start. And that is only phase one of a broader relationship that is projected to scale to over $500 million in cumulative purchases over 5 years. Plus, management is targeting gross margins exceeding 50% for their 800G optical engines once high-volume manufacturing starts.
Okay, $500 million over 5 years is serious visibility. But to fulfill $500 million in orders, you need massive manufacturing facilities. You need staff. You need working capital.
Which brings us to the balance sheet.
Right. To fund all this, they recently executed a staggering $400 million registered direct offering. Now, for anyone listening who isn't familiar, a registered direct offering means the company essentially created new shares out of thin air and sold them directly to institutional investors.
Which dilutes the pool.
Heavily. If you own a slice of the POET pie, they just cut the pie into way more slices, meaning your slice just got significantly smaller. That is painful dilution.
It is dilutive, yes, and I know that hurts retail investors in the short term, but think about what it actually achieves.
A lot of angry shareholders.
Well, yes, but that $400 million completely de-risks the going concern question. Before this offering, the market was constantly anxious, wondering if POET would just run out of money before they could fulfill those Lumilence orders.
Ah, so it buys them the runway.
Exactly. This offering secures the absolute war chest they need for the critical 2027 manufacturing ramp. They will not have to go back to the capital markets begging for cash in unfavorable terms anytime soon.
All right, let's talk about the actual product they are building with that $400 million. You mentioned a mass production moat. What exactly is their technological moat? Let's explain how it works.
It all comes down to their patented POET optical interposer and their new electrical optical interposer, or EOI. To understand why this is a massive deal, we have to go back to that 1,000-watt thermal wall we talked about earlier.
The server melting heat problem.
Right. When hyperscalers cram all these GPUs together, they use something called co-packaged optics to try and manage the heat and data speed. Normally, attaching tiny microscopic lasers and optical components to silicon is intensely labor-intensive. It requires active alignment.
Active alignment, what does that mean in practice?
Imagine trying to use microscopic tweezers to perfectly align tiny lasers into a minuscule gold box one by one. It is incredibly expensive, slow, and highly prone to error.
Good grief. So the traditional gold box packaging just doesn't scale for the volume of AI servers we were talking about?
Exactly, it's a massive bottleneck. But Puiti's interposer enables alignment-free, wafer-level production. Instead of tweezers and gold boxes, they can print these optical engines the exact same way semiconductor foundries print microchips, thousands at a time on a single silicon wafer.
Oh, wow. So they just print them en masse?
Yes, it completely bypasses that costly gold box packaging, it solves the thermal wall, and it creates a structural cost advantage that the older, less agile incumbents just cannot replicate.
Okay. If the technology is genuinely that revolutionary and the $400 million war chest is fully secured, that brings us to the catalyst timeline. What exactly are we watching over the next 3 to 6 months to prove this thesis is actually playing out in the real world?
The immediate checkpoint for your radar is August 2026, during their Q2 earnings call. The market desperately needs updates on the timeline for that $5 million Infinity order shipment.
Right, like are they actually on track to deliver?
Exactly. Then, looking a bit further out to late 2026, we are expecting engineering samples for the Lumilens joint development, as well as prototypes for Lithium. Those late 2026 engineering samples are the ultimate de-risking event. Once those samples are validated by the customer, the path to mass production is officially cleared.
See, I have to push back hard on that. Engineering samples are great for press releases, but they are absolutely not the same thing as high-volume mass production.
Well, true, but it's a necessary step.
It is, but creating a perfect prototype in a highly controlled lab environment is a very different beast than manufacture millions of them flawlessly on a factory floor. For me, the August earnings call is the immediate reality check. They have to show they are hitting their near-term execution goals right now before we start popping champagne over prototypes that won't see scale until 2027.
That's a fair point. We also have to keep an eye on the broader macro events, right? Because the industry context really matters. Ongoing optical conferences, like the Optical Fiber Communication Conference or OFC, are crucial to watch.
Why are the conferences so important?
That is where new customer design win announcements usually happen, driven by this massive hyperscaler shift toward co-packaged optics. The macro tailwind is undeniably pushing at their back.
And speaking of tailwinds and turbulence, now let's pivot to the chart, because the technical action on this stock has been nothing short of extreme volatility. It's been heavily fueled by all this news, even though you are arguing there is underlying structural strength.
The returns have been staggering. I mean, we were looking at a 90-day return of 138% and a one-year return of 211%. Make no mistake, there is aggressive, sustained accumulation happening here.
But the whiplash has been brutal for anyone caught on the wrong side of the news cycle. We saw a massive 114% gap up in a single week purely on the Lumilens news announcement.
It just skyrocketed.
Yeah, the stock went absolutely parabolic. And then almost immediately, a 12% gap down the very moment that $400 million registered direct offering was announced. To me, that 12% drop is undeniable proof of how sensitive this market is to dilution. It was a classic sell the news reaction from traders who wanted out before the news shares hit the market.
It was a sharp pullback, no doubt. But if we look at the underlying indicators, there is a massive silver lining for technical traders.
Really? Even after that drop?
Yeah, even after taking that 12% haircut, the stock is trading comfortably above its key moving averages. It's 13.9% above its 20-day simple moving average and 14.9% above its 100-day simple moving average.
So the trend is still up?
Very much so.
Yeah.
Furthermore, the MCD, the moving average divergence, which essentially measures the underlying momentum of the stock, is sitting at 0.2354, well above its signal line of 0.1214. That tells us the fundamental upward momentum is still completely intact. And most importantly, the RSI, the Relative Strength Index, cooled off to 54.18.
And for those newer to chart reading, an RSI of 54.18 means it's sitting right in neutral territory. It's not overbought and it's not oversold.
Exactly. That neutral RSI means the stock actually digested that massive dilution event incredibly well. The froth has been blown off the top. It leaves structural room for the stock to build a solid base here and prepare for its next leg up. rather than constantly trading in an overheated state.
Okay, with the chart showing that kind of battle between buyers and sellers, so what does market sentiment look like? Because looking at the headlines, the market seems entirely polarized.
Oh, it really is.
You have one camp of fundamental believers who see the wafer-level tech as the holy grail, and another camp that is totally spooked by the financial dilution and a bit of legal noise.
The news flow is definitely split down the middle. You have incredibly bullish headlines surrounding the partnerships with Lumilens, Lithium, and Lessingers, and then you have bearish headlines dragging the stock through the mud for the Q1 earnings miss and the share offerings.
It's hard to know what to listen to.
But if you strip away the headlines and look at the valuation models, the most followed institutional models place the fair value of PO at $17.37. That is well above the recent $13.90 close. So fundamentally, the math sees it as undervalued.
But notice what's completely missing from that picture. There is a glaring lack of formal analyst upgrades. The big banks are not pounding the table on this yet.
That's true, and they're staying quiet.
Instead, you have this massive wave of retail attention on platforms like Wall Street Bets, which is essentially providing a momentum floor for the stock. And when retail gets heavily involved, you get the rumor mill working overtime.
Oh, the rumors are everywhere.
Right. We're seeing rampant speculation about POET moving its headquarters to the U.S. just to qualify for domestic index inclusion, or even rumors of a buyout from a major semiconductor player who wants to own the optical interposer tech outright. It is incredibly noisy.
It is noisy, but let me flip the perspective away from the retail rumors and look at concrete institutional alignment. Let's go back to that massive Lumilens supply deal.
Okay, the $50 million one.
Right. As part of that agreement, POET granted Lumilens 22.9 million common share warrants. A warrant essentially gives Lumilens the right to buy POET stock at a specific price in the future. So let me pose a question to you as an investor. When your biggest future customer holds nearly 23 million warrants in your stock, do you think their incentives are aligned with yours?
I mean, yeah, they only win if you win.
Exactly. They only make serious money on those warrants if POET succeeds, fulfills the orders, and the stock price appreciates. That is the ultimate institutional vote of confidence.
That alignment is a really strong point. But even with incentives aligned, things can go wrong. Now let's talk about the risks.
We definitely have to.
Because regardless of how aligned Lumilens is, there are severe friction points between the company's current valuation and the flawless execution they need to actually justify it.
The execution leap is undoubtedly the biggest hurdle. Going from successful R&D in a lab to high-volume manufacturing is a notoriously difficult transition. It's a graveyard for many promising tech companies.
And it is heavily compounded by the sheer amount of equity dilution. I mean, they had to raise that $400 million because they are burning cash, but that heavily dilutes the existing shareholder base. And even after the stock dropped on that news, look at the valuation premium.
It's definitely trading at a premium.
POET is currently trading at a price-to-book ratio of 11.5x. Book value is essentially what you'd get if you sold off everything the company owned tomorrow. The industry average for U.S. semiconductors is 5.9x.
It's nearly double.
Yeah. You are paying an 11.5x premium on book value for a company with negligible actual revenue today. Add to that, there is a Faruqi and Faruqi Securities class action lawsuit with a lead plaintiff deadline of June 29th, 2026.
Right, the lawsuit.
The lawsuit is alleging tax misstatements and confidentiality issues. Paying double the industry average while the company heavily dilutes you and fights a class action lawsuit is a massive red flag that you cannot ignore.
I hear the bear case, but I have to push back on the severity of those red flags. First, let's address the legal issue. Securities class action lawsuits of this nature are incredibly standard microcap noise. Whenever a highly volatile stock has a sudden price drop, like it did after the $400 million offering, these law firms automatically circle like sharks.
So you don't think it's an existential threat?
No. It is highly unlikely to impair their core intellectual property or their manufacturing roadmap. As for the 11.5x premium on book value, yes, it's high, but that premium is completely justified by the fact that they have $500 million in revenue visibility sitting right in front of them with Lumilens. Their competitors simply do not have that kind of contracted massive visibility.
Okay, we've covered the technological moat, the painful dilution, the massive potential of the 2027 scale-up, and the very real execution risks. So with everything on the table, what's the final verdict?
We are looking at a bullish score of 8 out of 10. The opportunity here is clearly defined as an asymmetric, high-reward, high-risk play. POET Technologies is aggressively positioning itself as the critical enabler of AI's next evolutionary step.
And the Lumelins deal is the proof of concept.
Exactly. The Lemelins deal is the ultimate validation that this wafer-level printing technology works outside the lab and is ready for the real world.
It all comes back to that nervous system metaphor we started with. The hyperscalers have the brains, but they are overheating and choking on their own data. PoE is trying to build the optical nervous system that lets the whole body move at the speed of light without melting down. But, it leaves you with a fascinating thought to ponder.
What's that?
If PoE, or someone like them, doesn't successfully bridge this optical gap, do we simply hit a hard physical ceiling on how smart AI can actually get? We might literally just run out of thermal runway.
Precisely. It's a vital piece of the puzzle for the entire industry. From an investment view, this is definitively a multi-year hold, specifically targeting an 18 to 24-month horizon. It requires patient capital that is willing to completely ignore the near-term dilution anxiety and the legal noise, and instead focus entirely on riding that massive 2027 production ramp.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is grow $100 to $10 of K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you the next Smart Wealth with Joshua episode.